Our panel today is the outlook is on the outlook for the financial markets for next year. On my immediate left is Joe Bruselis. He's the chief economist at RSM, one of our sponsors, formerly an economist at Bloomberg. His name is getting a little bit more famous lately. Next to him is Professor Mark Germaise. He's a very distinguished professor of finance here at the Anderson School. Very distinguished, almost, close?
I think that's a little strong, but okay.
Okay. Sitting next to him is Arthur Hovespian. Close enough?
Close enough.
He's a principal in emerging market debt at Payden and Regal, and Payden and Regal has about 115 billion
Correct.
assets under management, located here in LA.
Yes.
UCLA alum.
Yes, absolutely.
Very good. Next to him is Jia Yi. Is that correct? She is a co-chief investment officer at First Quadrant. First Quadrant has $14 billion of assets under management, and they use a very quantitative approach to investment strategy. So my first question is for those of you who saw our forecast, I'll go to Joe first since he does economic forecasting. How far off are we on our forecast for the next 2 years?
Well, since we were generally aligned with the growth forecast, as well as the employment forecast, I definitely liked what I saw. I think in terms of thinking about financial markets, I don't see the Fed doing much of anything next year for two basic reasons. First is the obvious, there's an election. But second, I think the Fed's about to lift their inflation, or change their inflation target over to what I would refer to as an intertemporal target, or which is essentially going to allow the Fed to cost average what they're doing. So if you run for 5 years at 1.5% on your inflation target, the next 5 years you can run at 2.5%. So we're going to enter some new terrain next year, and I just don't think it's conducive to the Fed actually cutting rates. I'm somewhat skeptical of what the forward-looking markets say. They're very thin in illiquid markets. They're good 30 to 60 days out, but not good 6 to 12 months out. So I think that the UCLA forecast is well positioned to look quite prescient a year ahead.
So it's like stop clocks. We'll be right twice a day.
That's right. We're always going to be right once a day, twice a day.
On that, what do you think about my view on automobile sales?
All right,
credit,
so
auto credit, because this is one of the places where we're away from consensus and we're out on the limb a little bit.
Well, I think that there's some credit quality issues inside automobile lending. If you look at the quality of the lending throughout the cycle, 23% of loans have been of the subprime variety, and you can see the banks already beginning to tighten lending. So I think that we likely will see a decline in overall sales first half of next year, and it does make sense given the transition away from traditional lending as we knew it before the Great Recession.
Okay, anybody else have comments on our forecast? Those of you who saw it? Any on the panel? Anybody? What do you guys?
I'll comment. Unfortunately, I missed the earlier part of the session, so I didn't hear the exact forecast, but just from our perspective, I think the outlook remains pretty good for the US. Global PMI numbers, obviously, in recent months have been picking up. That should still kind of continue in coming months. Looking back, in many ways, I think the Fed probably tightened too much. That sounds strange given what Vijay was talking about earlier, but really, I think the importance of the feedback loop back into the US economy is very strong. And I think that has an important part to play. But the Fed has been undoing those rate hikes, some of those rate hikes, and that's allowing the rest of the world to also ease monetary policy, because last year they were tightening really at a time to defend the volatility, against the volatility. So I think we're pretty constructive on the outlook still, because we're seeing troughing out in global data in particular, and we're pretty constructive.
One more thing, I think it's important to note that we've got a relatively unbalanced economy right now. 20 to 25% of the economy, the portion that's involved with manufacturing, agriculture, and transportation and logistics to support both those ecosystems, are still contracting. It's not a good picture. And when you get over to the consumer service area of the economy, yeah, we're doing okay, but we're just slowing back to the long-term trend. And if you think about some of the policy choices that have been made over the past 3 years, right? $2.3 trillion tax cut, the launching of a multi-front trade war. I think there's sufficient concern about the direction of growth over the next couple years, especially if the trade war is intensified and or expanded to include auto imports from the UK and the EU next year.
Okay. So far this year, stock prices are up 24, 25%. You know, it's been bouncing around a little bit. Total return 1.5% higher than that. A friend of mine who consults with some of the pension plans that were discussed today said this year we got 4 years of return in 4 years worth of return in equities this year, and we got 3 years worth of bond returns this year because there's been a huge bull market in bonds. So my question is to go around the panel, start maybe with Gia. Do you have what would you view a long run normalized return for U.S. equities? Do you have a view on that?
We don't have a view on the long run return. We're quite sharp. What we do is that we don't make predictions of where the macroeconomy is going, but what we do is that we are looking at the current market environment and make assessments of where we should position our portfolio towards a particular asset or towards a particular style. But so currently we do have an overweight on the equity market, and so that is coming from a few different considerations. First consideration is that the investor risk appetite is still pretty robust. If you're looking at equity risk appetite, you look at credit risk appetite is pretty robust. The other thing we look at is looking at the global yield still remain very low, and it has continued to decline in the last few months. And for the opportunity, as we mentioned that there's cash on the sideline. When people want to invest, where do they go? And equity market is a good place to be. The other thing we're looking at is the institutional flow information. So we see the asset flow in the last few months to a year still point to pro risk, and that coupled with the overall exposure to risky assets are actually below historical average. So that point to a positive, cause us to have a positive exposure to an equity market.
I know, Arthur, you're a fixed income guy.
Yeah.
Does your shop have a long run view on equity returns, normalized returns?
Unfortunately, I won't be able to comment on that side of things, but maybe I can comment on the fixed income area that we focus on.
What would be a normalized return for emerging market debt?
Yeah, so emerging market debt, I think, surprises people sometimes because of the volatility and the media coverage it gets. But over the long run, it's averaged out at around 7%, 6 to 7% is probably a good estimate for the future as well. Obviously,
that's in dollar terms,
dollar
not local
terms.
currency.
Correct. So that is in dollar terms and in dollar-denominated emerging market debt. Obviously, there's also local currency debt, there's corporate debt, but overall, I think for the asset class, going forward, there's no reason for me to believe we'll deviate too much from that. In particular, if you're looking at some of the local market countries as well, or fixed income instruments out there.
Okay, Mark, do you have a long-run view?
Sure. Usually expressed relative to the risk-free rate, a premium of, say, 4 to 7%, I think is the
4 to
standard
7,
view.
so
Yeah.
that would be risk-free equal to right now?
Yes, roughly, yeah.
So it's roughly 6 at the low end, something like that?
On average, yes.
I'm not saying,
Yeah,
I'm not
yeah,
asking you to forecast next month or next year.
Okay, good.
I
I don't have a forecast.
I'm just taking a look at, if you have to make long-run decisions, especially since we discussed pension plans before, is you have to have a long-run view on what kind of rate of return you're going to get, and that's how they come up with their expected return. You need an estimate of return for equities, you need a return on debt, and a return for alternative investments to come up with a weighted average return. So you have to do that. Somebody has to do it.
Yeah, not just pension plans. Any company making investments needs to think about opportunity cost of capital.
Right.
Yeah, it's a crucial number.
Okay. Joe?
Well, so we're not in the business of making long-term forecasts about return on the equity markets. We do a couple things. I'm a big believer in using Tobin's Q to estimate the total valuation of equity markets, which suggests that we're modestly overbought. And then when we were at Bloomberg, we created 2 different financial conditions index. sort of estimate daily risk appetite. One is more of a pure model. It's about half a standard deviation above neutral, which suggests there's plentiful liquidity and risk appetite still plentiful. And then we have a financial conditions index that includes housing and technology to reflect the changing nature of the U.S. economy. And that's about a 1.5 standard deviations above neutral, which suggests that, absent risk around the election, the equity market should do quite well next year.
Okay, well, you can't say absent the risk of.
Well, and then that's the thing. My sense is
that's
that
like a classic economist
the market will
goes.
float up until we get a Democratic nominee, and then it will flatten out until after the election.
Because the classic economist joke is you assume a can opener even if you
Yes.
don't have a can opener to open the can. Gia, you're in a quantitative shop, and you just generically, quantitative models haven't been working as well as they historically have worked. Could you comment as to what's going on there, and what kind of investment style approaches that would make sense for next year in your shop that you're looking at? Growth over value, value over growth?
Yeah. So our equity strategy, what we do is that we dynamically allocate risk across a pool of return drivers. And as David said, that we maybe because of factor investing, the popularity of factor investing, there's a lot of money chasing the factor in certain styles. And so if you are holding a static weight in any kind of styles, typically it would not do well. So what we have found is that if we actually dynamically allocate risk across the styles, the kind of approach actually added quite a bit of value in the last few years, especially in North America. In Asia and in Europe, the traditional factor investing still do much better than North America.
So in the U.S., what kind of style are you favoring now in your shop?
So we had, so at the beginning of the year, we really underweight value, and so just recently we a little bit overweighting value, and that is from the perspective that the cheap stock is becoming even cheaper from a historical perspective. The other thing is that the market started to take note, so you see the value started to rebound, and that coupled with a robust risk appetite, then it will support further recovery of value. But we adjust our position very frequently.
Okay.
So our position is very sensitive. The value bet is very sensitive to the overall market risk, as we have seen in the last few weeks and last few days.
So how would you define value for our audience here? So the average member of the audience would know what value means in your space and how you look at it.
Yeah, so we look at value from a composition of a lot of different measures. We look at value from the perspective of asset base, earnings base, sales base, and cash flow base. And we look at a combination of all.
So you're looking at low price to assets, low price to cash flow,
Yes.
low price to earnings, and that's value.
Yes.
As opposed to high prices to earnings, high price to book.
That's correct. And in the last few years, we have actually done well in the value space just because we're playing a spread position. So we overweight cash flow-based value and we underweight asset-based value.
Okay.
And that spread has done very well for us.
Okay. Mark, when we had our conference call, we talked about you were concerned about the leveraged loan market, and we also had a couple of slides here earlier with a couple of former speakers and stuff. Could you comment as to what you see going on in the leveraged loan market?
Yeah, so I saw our keynote speaker highlighted this too. A couple of things to be concerned about. One of them was actually up in his slide was the increasing prevalence of covenant-light bonds. So these are
define covenant.
Yeah, these are bonds that have very few restrictions on the ability of the borrowers to use them. And limit the ability of lenders to intervene if the borrower's earnings drop. Those are typical covenant provisions, and a lot of the debt that's been sold over the last 5 years has not included those provisions. Those are called covenant-light bonds. Those are fine when the economy is doing well. But I think there's a lot of concern about what will happen if there's a downturn and lenders are unable to intervene, and a lot of the protections that lenders typically have will be lost. That's one issue, just increasing frequency of covenant lights. I think the keynote speaker showed something like 75% of all the leveraged loans now are covenant light. I think recently it's even closer to 80%. That's one area of concern. A second area is EBITDA add backs. So our keynote speaker talked about calculating debt to earnings ratios, and what are earnings? That's usually EBITDA.
It's earnings before debt, interest.
Earnings before interest,
depreciation,
taxes.
interest, taxes. Earnings before all the bad stuff, basically.
Right. Okay. Yeah, exactly. No, take out depreciation, taxes, interest. And so lenders usually look at that, and they might decide, okay, we'll lend at 5 times EBITDA to a private equity firm. The speaker had ratios of 2.5. That would be kind of a more standard corporate rate. But in general, you're looking at how much do you have in the way of earnings to support the lending. So recently, firms have been getting a pass on putting in add backs to their EBITDA. We're going to make restructuring changes that will save a certain amount of money. We want credit for that now. We're going to add that into our earnings. And S&P started calling it marketing EBITDA.
Yeah.
Not a good sign. Yeah, okay.
Okay.
Performance just over the last month or so has also not been great. For something like 50 bonds have started to really suffer. So I would say that's a place to look. If you're bearish, I would focus on what's happening in the leveraged loan market.
Do you have do those concerns spill over to the $10 trillion corporate debt market, where basically half the issuers are BAA, which is the lowest grade of investment grade bonds? Does it spill over to that?
So I don't know, but I would look there first. So I think subprime, it's now generally agreed, caused the last credit crunch. If there's going to be another credit crunch, I would expect it to start in leveraged loan. I don't know. There could be a little tempest in a teapot over there that doesn't affect anything else. Hard for me to say.
Now, have you gotten granular there? Then a lot of the problems in the triple C and the low double Bs in the oil and gas sector, is it broader than the oil and gas sector, which I know has been in a lot of trouble?
Yeah, it's not just energy and retail. A lot of the activity has been energy and retail, but it's not just energy and retail. And you're alluding to the debt ratings, the triple Bs. That's another issue of concern, because if things get worse and ratings start to suffer, a lot of these bonds will stop being investment grade, in which case institutional owners can't hold them anymore. I don't know what you folks do. Suddenly there's a rush to the exits, everybody's selling these. That could be a trigger.
Do you have a comment on it?
It's not the area we focus on, but
okay.
definitely that's a risk.
I want to follow up one more thing with Mark. Is there's a bill in Congress with some Democratic sponsors and Elizabeth Warren in the Senate. It's called the Stop Wall Street Looting Act of 2019. It sounds like Jerry wrote the act on that, and basically they're calling private equity predatory. Private equity, basically they're going to make the liabilities recourse to the private equity sponsors. It's going to limit it, upstream dividends, rearrange preferences and bankruptcies. Does that legislation make sense, Mark?
Okay, just a couple of things on the neutrally named Stop Wall Street Looting Act.
Very, totally neutral.
Yeah. When I first read it, I was sort of impressed by how much Senator Warren, I guess former Professor Warren, knew about private equity. I mean, she really
knows lots about bankruptcy.
She does, yeah. And she does, and she knows a lot about private equity. She really got into the guts of it, which was interesting to me because she's clearly not overly sympathetic to the industry. So some of the pieces I think are fine. More disclosure of borrowing on the parts of private equity firms, public disclosure of borrowing. I think that's fine. Some of the pieces people in the industry don't like, as you mentioned, the restrictions on dividends and monitoring fees and maybe treating carried interest like ordinary income. But the piece that has attracted the most attention is the one, David, that you alluded to, which is making the private equity firms responsible for the debt of their portfolio companies. Some people in the industry say that'll just end private equity investment. I don't think that's right, but I do think it'll change it for the worst. I mean, one of the nice features of private equity is they buy up 10 companies, they do their best to improve operations, and some of them fail and go bankrupt, and that's perhaps because they couldn't be saved or weren't managed properly. And that's a key part of the model, is you succeed with some firms, with others you don't. And if you have cross liability, that's not going to happen. You're basically going to turn private equity firms into old-style conglomerates, which is kind of ironic because private equity initially was designed to break up old-style conglomerates. So I think that piece, clearly not in favor of.
Go ahead.
We're quite skeptical of these sort of proposals. That we feel in a modern financial economy, private equity plays a very important role in terms of, restructuring failing firms. But one does get the policy coherence of Elizabeth Warren. If you're going to put in a wealth tax, you're going to create conditions for a great flow of capital to private equity. And unless you put constraints on that, all you're going to do is end up distorting the economy in ways, I think, that are counterproductive. And even then, it looks to me like this is something more of another one of these aspirational goals or transformational goals that don't have any reservoir of support politically inside the United States Senate.
Okay. I have a question.
Sorry, can I just,
Go ahead,
just to
please.
follow? I just wanted to follow the reasoning. You're saying if there's a wealth tax, money is going to pour into private equity because it's just harder to evaluate that wealth. And
you don't have to mark to market.
you don't
right?
have to mark to market. Okay.
Yeah. I mean,
it's a good point.
if you're in New York City and you talk to private equity guys, they're all salivating at Elizabeth Warren getting a wealth tax passed, but then the U.S. Senate bottling up the Stop Wall Street Looting bill. Right?
I have a question for Mark. Private equity has historically had very, very good returns until maybe very, very recently. But my question really is how much of, and I think you've done work in this area, how much of the private equity return has just come from pure leverage? That they're just, because basically is an individual investor could mimic private equity by just buying the S&P on margin, and you can make great returns because the market's been going up. So how much of it's come from a pure leverage effect, and how much of it has really come from like an alpha effect where they're really doing something to improve the company? Do you have any data? Can you any information on that?
Yeah, so that's just quite a subtle point, and most people don't think about that when you invest in private equity. You're effectively investing in highly levered equity. Right. So just a little bit to question your premise, I want to take out VC, venture capital,
Sure.
Sometimes included in private equity. Actually,
you have to take out, VC is different.
Yeah, returns haven't been great.
Yeah.
But for buyouts, the buyout piece, more traditional private equity, yes, even accounting for leverage, accounting for risk, comparing it to other asset classes, I think the evidence over the last 25 years is there has been alpha. There's some dispute about that. That's my read on the literature as a whole. I think there has been alpha on that sector.
Alpha means is they've done better than just the leverage, making money off of the leverage in the market going up. I have a question on the dollar. All of you have an obvious interest in the dollar. So go, Arthur, how do you see, somebody said the dollar is going to get devalued. One of the questions, so what is your firm's view on the dollar, say over the next, say, 6 to 18 months on the foreign exchange value of our dollar?
Sure. Well, I think obviously the US dollar's been on a secular bull run for the past 7 years or so, and more recently that's been on the back of US exceptionalism versus the rest of the world, the outperformance of the US versus the rest of the world. Obviously interest rate differentials played a huge part with the Fed diverging from the rest of the world. We're at a point where we see that rebalancing and kind of the secular bull run ending. We're in that kind of period where the top is being put in for the dollar from our perspective. And why is that? Firstly, that outperformance of the US versus the rest of the world, in our opinion, has reached a limit in terms of from this point on, you're not going to see the pace of that outperformance or in the near term, at least the next 6 to 12 months, we're going to see a rebalancing of that. So the rest of the world is starting to grow again. And as I mentioned earlier, the easing of monetary policy that's been done this year, together with the other stimulus, fiscal stimulus in some of the countries, with the US fiscal stimulus fading, this is combined to kind of bring that growth story back into line. You've already seen the Fed obviously ease policy. The curve is starting to steepen. And in the backdrop, you've got a pretty problematic fiscal situation in the US. These are all negatives for the US dollar. So we're looking out for the dollar to be setting atop. What is a big headwind to all of this, obviously, is the concerns around trade tensions and the trade war. That temporarily will provide support for the US dollar from our perspective, but the Fed has in many ways shown their hand as their response to that happening. And for us, the overall picture for the US dollar in this environment is one of at least stabilizing, if not coming down.
Gia, one of your factors, I think, is the value of the dollar. Is that one of your factors in your models? Do you have a...
Yeah, so I would have passed that because this is not an area of my expertise.
Okay. You used to play in foreign currency, Joe?
Yeah, I even wrote a book on it.
You wrote a book on it?
Yeah, they got published, yeah.
Okay.
It was a peer reviewed, I didn't cheat. Okay, so I'm in general agreement with the sentiment expressed on the panel that we likely seen a top in the 7-year bull run in terms of the dollar. Now that being said, if there's risks around that forecast, it's the resumption of asset purchases by the European Central Bank and the arrival of Ms. Lagarde at the bank, which to me signals perhaps at one point an increase in fiscal outlays by the German state and other European economies, which perhaps not in 2020, but in 2021 and in the out years, we may have to reassess that top. And I think that's one of the major discussion points about interest rate differentials, the blowing out of fiscal deficits or the shrinking of the fiscal and current account surplus in Germany.
Okay, I have a question because I know you don't predict asset prices, so I'm not going to ask Mark.
Thanks.
But I have a question for Arthur, is when you're looking at sovereign debt, there's lots of things going on in the world right now. You have these huge demonstrations in Hong Kong. You have a return of Peronism in Argentina. You have Mexico's move to the left and now in recession, political risk. Chile is seeking a new constitution where one of our professors here, Sebastian Edwards, says it's the end of neoliberalism in Chile as a result of the recent demonstrations. You have Morales forced out in Bolivia. So when you look at all at sovereign debt, how do you evaluate the political risk associated with sovereign debt?
First off, I think that if you'd asked me that question, the situation we're in 2019 compared to even a decade ago in terms of investment, on the investment side of things, we have so many options to invest in. We have 80 countries to invest in. Obviously, these countries are going through a tough time, and there are reasons which I'll get into. But the main takeaway for us is you look at the protests, and you can split them pretty much into two groups. The first group, and those would include Ecuador and Chile, where you've had removal of fuel subsidies that triggered underlying discontent with the administration. In Chile, you've had years of buildup, which was triggered again by increase in metro prices, where the population is upset with how the pension system is funded, with how the education system works, et cetera. So these are all underlying issues that are coming to the fore. The good thing for us is there's a this is democracy in action here in emerging markets. These are economic protests in many ways. You've got then the separate protests occurring in Hong Kong, which are more social and in many ways defending of sovereignty for Hong Kong, and that is a separate category. Hong Kong is not in our investment universe, however, it does have a big impact on risk sentiment, which does ultimately feed back into emerging markets. But I think all of these situations are occurring at the same time, and it's not a surprise because one is probably triggering the other one. And a lot of it seems to be centered or coming out of Latin America. And Latin America as a region really benefited a lot from the 2000s, pretty much to 2009, And then since then, from the commodities boom, since then, they really haven't seen that, and because of huge commodities exposure. And therefore, this has been building for the past 10 years, really, because the growth hasn't been there. The population originally was probably satisfied by just having shelter and food, but now they want greater things. They want services, they want education, healthcare, etc. And it's natural for them to protest. But for us, with a universe of 80 countries to choose from, it's important for us to navigate away from these countries while they're going through these issues. Obviously, near term, it weighs on the economic activity and growth outlook for these countries. But ultimately, it's good from our perspective to see this because it shows that there is democracy present.
So what countries are you navigating to right now then?
Actually, in line with that question, and also a country that we like, is a country like Indonesia. A few years ago, reintroduced fuel subsidies. And at the time, they were being criticized quite heavily by investors for the negative impact that would have on their fiscal balances. But ultimately, that's allowed them time to implement some important structural reforms domestically. Indonesia is a country we do like. They have a consumer-driven economy, and so in some ways they're insulated from all the trade tensions. And the policy making has been very solid in recent years, in particular the monetary policy. Last year, Indonesia hiked rates, even though inflation was all-time lows. That's not something we'd like to see, but at the same time, it does show credibility of monetary policy making.
Okay. My other question is why do... let me ask a question about China. China sold some dollar-denominated bonds last week, I think?
Yes.
30 over, 40 over, something like that? Pretty tight spread. Did you guys play in that?
We did not.
Okay,
We
why?
did not.
It was
Just
too
from a
narrow?
valuation perspective,
The yield is too
unattractive.
low.
Correct.
Because China, instead of issuing bonds in yuan, they issued bonds in dollars and paid back in dollars.
Were those available to foreign investors?
They weren't to U.S. domiciled investors.
But it was like a premium of 30 or 40.
But we have clients that we could have bought for. But we passed on the first time they issued as well, simply on valuation,
Okay.
unattractive valuations.
Okay, my other question is one of the leading serial defaulters in the world is Argentina. And it would seem and then international investors, going back to the Barings failure back in 1890, always go back to Argentina. And is there any adaptive learning in your market that you'll say, never again lending money to Argentina, because they always default? So how do you look at, say Argentina, looking at investing in Argentina?
I mean, that's a difficult one. It's been one that has affected a lot of managers this year in particular.
Huge
obviously,
this year.
Huge.
Yeah.
They obviously in hindsight have taken on more debt that they could deal with, and in the meantime, ironically, policy making has been good in that they've taken tough decisions, but unfortunately, the population has suffered as a result because of the higher inflation and the tougher kind of policy making decision, higher rates that they've implemented.
60%.
Correct.
Yeah.
Exactly. So
A slight tightening of monetary policy.
For us, I think what's important is to really, in terms of our portfolios, is to size positions appropriately. The elections in August in Argentina surprised everyone. Leading up to the elections, all the polls were actually pointing the other direction, with the current, the existing administration, Macri's government, staying in power. Obviously, that completely reversed on the elections, and everyone got caught off guard. I think what's important is in our portfolios, is to size positions appropriately. Going forward, I'm sure people are going to be returning to Argentina to buy more debt.
I know, there's one born, as P.T. Barnum said,
Right.
there's one born every minute. I want to ask...
Could we go back to those Chinese bonds? Why was the government of China doing that? In your opinion, they've got huge reserves of U.S. dollars, and they clearly don't need the cash. Any thoughts on that?
That was a question when they first issued, because the issue size was rather small for their economy. It was nothing. It was a few billion for the Chinese economy was really hard. Wasn't going to move the needle. For us, initially we were speculating. They just wanted to make a statement that they could issue at a level close to treasuries. I think that first issuance traded flat to treasuries on the break after the new issuance. And why they've come back, it's really something that we don't know. Again, they've tapped the market with an amount that isn't material for their domestic economy. Maybe to build out the curve. Ultimately, they want to be present in global financial markets from all aspects, not only domestically, which is a market that's opening up, which is going to be very big next year, actually. It's only owned by 2% of foreigners, and it's the second largest bond market in the world, the domestic market, but maybe they're trying to diversify as well into external markets.
Is there a state-owned enterprise debt crisis coming in China? With the debt on the SOEs?
We don't believe so, and that's largely because of the control over those SOEs, obviously, by the government. So in essence, it becomes government debt. If you consider it as government debt, then the debt ratios remain very comfortable for the government.
Okay, Joe, you talk to middle market clients because your firm is middle market firm. You talk to middle market clients every day. What are they telling you? What industries are doing better? What industries are doing worse?
Well, as long as you understand what a middle market company is, it's a company with revenues of around $10 billion to $2 billion. They account for about 40% of GDP, and they employ 1/3 of the labor market. Right now, if you've got pure domestic exposure, you're doing quite well. I mean, our middle market business index survey, which we'll release next week, it tells us that the sentiment's quite strong. Revenues, net earnings. We got strong majorities showing robust net earnings, and margins are great. Now, if you have exposure to the global sector, or you sit in an ecosystem with large multinational active companies, things are a little bit more challenging, right? In the third quarter, we did a survey around the trade conflict. What did we learn? Right, 40% of our respondents are having real issues adjusting to the trade actions taken by the United States. What was more interesting was 26% said they were experiencing adverse impact from trade retaliation from our trade partners. What that tells you is that Main Street is far more embedded in global supply chains and has exposure to global financial flows than anybody expected prior to the launching of the trade conflict. And when I say anybody, I mean the knuckleheads at the White House and Paul Krugman. Yeah. All right? No, literally. We're learning something in real time here about what's occurred over the past quarter century.
Paul Krugman is a real big trade economist.
Oh, yeah, no, yeah, Paul, yeah, no.
Not the New York, not the Krugman version in the New York Times.
No, the Krugman version I learned in undergrad school from his textbook. Right. Right? Yeah, no, we're learning something in real time about just how enmeshed the U.S. is in this global supply chain, and how when you saw the chart earlier, we're sitting right in there now about 12.7 trillion in negative yielding equities. There's another trillion in private label securities. That's just not a function of central bank policy. That's the fixed income market expressing a forward look on the cost of deglobalization and the disruption of supply chains. So we're learning something there. In terms of the industries, if you're in transportation, it's very difficult right now. It ties back in with Jerry's California forecast, which you can really see it there in the data. Because with the appropriate 18-month lag one would expect from the disruption of global trade and the attempt to tear down the global rules-based order, yeah, we can see it, we hear it from them.
And any industry is really doing great? Could you comment? Anybody? So we said transportation is doing horrible.
Transportation's doing
horrible. Who's doing great?
Well, tech. Certain parts of the service sector are doing very well, linked to just basic spending, right?
Like what?
Well, we're doing very well.
Okay, accounting.
Accounting, financial services are doing quite well. We're seeing it whether it's our credit union. Private equity slowed a bit, but still fairly strong.
Okay. I'm going to ask the hot potato question, which I don't know if anybody's going to answer, but I'm going to ask it. My friend Leon Cooperman, who has gotten a lot of airplay on CNBC, and he wrote an open letter to Senator Warren. And he made a comment on CNBC that if Senator Warren got elected, stocks would go down 25%. Now, not necessarily on the election, if the market anticipated her election. Stock market would go down 25%. Paul Tudor Jones, another hedge fund guy, said something very similar. So from the panel, anybody want to take a stab of agreeing or disagreeing with my good friend Leon Kuberman? Anybody? No.
Leon's a client, so I'm going to take a pass.
I'm going to comment. I'm going to comment. And if you just take a look at the program, and I'm not going to comment on whether 25% is the right number or the wrong number, but I'm going to comment. If you have a program that will substantially increase corporate taxes, which will obviously then lower after-tax earnings, and that's beyond dispute, that part of a program. And if you also have a program which says you're going to tax very wealthy people with over $50 million, and they're going to have to disgorge anywhere between 2% or 6% because it's a moving target paying for the Medicare part of the program they're going to have to sell. So you're going to have more stock into the market, basically, because Jeff Bezos is a rich guy, but I don't know how liquid he is you get forced selling in the market. You would kind of think is maybe there would be a little bit of downward pressure on stock prices. Now, whether it would be the full 25% or whether it would be 3% or 40%, you don't know the number, but the thing is this is, and you also have a view is that they don't like billionaires, they want to have them poorer. That also, how you get people poorer is you lower the stock market. That's how you get rid of billionaires, you have a stock market crash, which is what happened in 2008. That's how you got rid of a lot of billionaires, disappeared in 2008, at least temporarily.
How many billionaires are there?
A lot.
A lot. Yeah. This sounds a lot like the alternative minimum tax in the 60s, narrowing.
So my sense is without putting a number on it, I would think directionally Leon is right. I have no idea what the percentage number would be. And that's just looking at supply of stocks and significantly lower corporate profits. You would probably say, if you said corporate profits are going to be down 10% or 15% next year, which none of our speakers said, you would think, and the macro, where are stock prices, higher or lower? Most people would say lower, as an intuition. I have one last question for Mark, and then we'll open it up to the audience. My question is, you teach lots of MBAs, finance here, the Intro to Finance, Advanced Finance courses.
Corporate finance, yeah. The second class,
yeah. The second class, you see. What one or two lessons would you like them to take away from your classes that they would get, so we could give everybody a mini MBA here right now in finance?
Okay. I guess so what are the big picture lessons from finance? Yeah, number one, diversification. I think that's kind of that's a big concept. I guess another kind of important concept from finance is opportunity cost. So if you're making one investment, that comes at the cost of other uses of that capital. I'd say that's important. And then probably the third big idea of modern finance has to do with option pricing. That really was a significant technical accomplishment. Everybody recognizes that options have value. It's intuitive. You want more options. More optionality is helpful. But to actually come up with a model that can price them as Black & Scholes did and have some intuition for that, yeah, I think that's a big idea.
Okay, you got your MBA in finance. Okay, thank you very much, everybody.